Kevin Minton, and I'm the owner and CEO of Chief Executive Boards International. I want to thank everyone for taking time to join us for today's webinar, Risk Mitigation. And really our goal today is to identify and discuss the various direct and indirect business risks that CEOs should pay attention to, and such as the financial, operational, and strategic risks. So, Chief Executive Boards is headquartered in Greenville, South Carolina, with executive and peer advisory boards in multiple cities throughout the United States. And I'll be your host today, and I'd like to invite you to stay tuned for future webinars on our website, which you'll see located at the bottom of the slide on the screen. But before we dive straight into our main topic, you might be curious to learn a little bit more about Chief Executive Boards. We're a boutique executive peer advisory service with local and national boards located throughout the Eastern and Midwest United States. And the purpose of CEBI really is to help CEOs, presidents, business owners to share ideas and experiences to avoid pitfalls and potholes that many have already experienced. We really help to steer you from reinventing the wheel within your own businesses, and essentially it's where highly successful chief executives go to become more successful. Our members, they convene face-to-face in local forums and receive unvarnished advice in a safe and confidential environment that's typically unavailable elsewhere. So it's really like having your own personal think tank. As an example, we address, really what keeps you up at night. Items you don't have an opportunity to discuss with anyone else, such as family or employees or friends. So our members can avail of our local and national advisory board forums. They can attend additional educational summits. They have access to other chief executive board members throughout the country, our libraries, our workshops, and of course our webinars, which you are participating in today. I'd like to advise you of a couple of housekeeping items. First of all, you can post your questions in the dialog box to the right, and we'll answer your questions at the end of the webinar. This webinar is being recorded and will be available for you to review on our website within 2 days. So with that being said, let's get started with our webinar, Risk Mitigation. I'd like to introduce our guest presenter today, Mr. Norm Poole. Norm is the founder of Money Pool, which takes a holistic approach to helping business owners on a multitude of fronts, as well as individuals, mostly using financial analysis and analytics to make improvements in their business. Today, in this risk mitigation webinar, we're going to cover things such as, what does my CFO's personality have to do with risk? Have I evaluated all the operational, tactical risk for my company? Have you ever heard of cash flow risk, and what is that? Should I be using financial ratios to analyze the performance of my organization? Have I thought through all the various strategic risks? So this webinar is going to last about 45 minutes, and we'll take a few minutes at the end for questions. Our contact details will also be listed at the end of the presentation, and we'd love to hear from you. If there's any particular segments that you'd like for us to dive a little further into, just drop us a note, and we'll look at having another webinar possibly later this year, diving a little deeper into some of these topics. So at this point, I'd like to turn the webinar over to our featured presenter, Mr. Norm Poole. Norm?
Thank you, Kevin. Good morning, all. Kevin, first of all, this webinar was keeping me up last night. Hopefully you can help me with this. First of all, I want to tell you guys that this is intentioned to be thought-provoking, whether your business is big or small, retail, industrial, family or whatever. This is kind of a generic overview of what risk might be in for your company or you individually. What I'm going to go into first is tell you some of the risks I've identified. I broke it into direct risk and indirect risk based on my own personal filing system. I've been on your end of the webinar a lot more than I've been on this end, so I'm going to try to speak slow. I'm going to try to not provide death by PowerPoint. I'm going to dive into some of the slides a little bit more than others, and I'm not going to read every slide and every line because if you're like me, I tend to read ahead and know what's going on anyway. All right. Risk is defined as a possibility of loss, injury, disease, or death. And we want to mitigate the risk, which means less severe or painful. And an entrepreneur is one who organizes, manages, and assumes the risk of a business or enterprise. And entrepreneurs are normally not risk averse. They like risk. And here's some of the categories we're going to talk about today as far as direct and indirect risk. Some of the direct risks may be low for you and high for others, and vice versa. The first direct risk is financial. Accounting mistakes or misstatements could lead to shareholder mistrust. And that's assuming you're a large corporation with a multitude of shareholders. But even if you're an individual running a family business or a small business, fraud or inaccurate record keeping or even non-compliance with Sarbanes-Oxley can have a huge impact on your organization. I cannot tell you personally how many times I've had a small business owner that has a part-time bookkeeper that robbed them for 6 or 7 digits. So make sure you know who's watching your money and have dual controls or have sharing of duties so there's more oversight than just one person. Cash flow risk, as Kevin talked about earlier, not many people talk about cash flow risk. But what could happen if you have an inaccurate budget or forecast? What's the impact from non-cash items like inventory, accounts payable, or accounts receivable? What do you do with excess working capital? Do you invest it? Do you pay down loans? How can you increase cash flow? Well, I've listed a few items here, but obviously issuing stock has effects more than just increasing cash flow. It's also going to have dilution to the other shareholders. Selling inventory. Are you retail or non-retail? If you have a lot of inventory, how often is it turning over? Are you analyzing? Are you watching it? I've done a brief analysis that even I can understand. It's kind of an elementary level of an income statement. We look at the revenue, cost of goods, gross margin of 40%, which is $40,000, overhead of $5,000, profit of $35,000. So the small business owner, he may think, great, I made $35,000 this month. But if he's managing just by the income statement, he may not have seen the other side. What happens when you add in depreciation? Your accounts receivable, let's say it increased by $10,000 because you added a new customer who doesn't pay in a timely manner. What about payables? Say your payables decreased and your inventory increased. You made an impulse decision to buy a bunch of inventory at a good price, so your inventory went up by $25,000. Well, your net cash flow went down $1,000, and you have no idea why you had to dip into your line of credit. This is just a very elementary sample of what can happen on your cash flow and risk. To give you a brief example in this, I met with a client one time. When I first met with him, he had a small CNC shop, and he was selling parts to Ford Motor Company up in Michigan. He did not have an income statement. He did not have a balance sheet. He was managing by the checkbook. Needless to say, he had more opportunities there. Moving into credit risk. Make sure your company is not seeking more money than you can pay back in a timely fashion. And then, as your mother always said growing up, always ask for credit before you need it. Because when you need it, you're not very bankable. That was a short slide. I'm going to move over next to quantitative risk. We normally hear the quantitative analysis or term used on Wall Street, but I look at it from an analytical risk versus return. When you look at the quantitative risk, what's the impact of your cost, your volume to your profit? Are you break even? How well are you utilizing your assets? How well are you utilizing your management team? How well are you utilizing the equipment? If you're analyzing, looking at a new business scenario or a new venture, what's the net present value and internal rate of return? What's the return on the original investment? For the shareholders, what's the return on equity? How well is your invested capital performing? If you could get better return in a bond, it's not a very good business scenario. Next, a quick slide on modeling risk management. Supply and demand, how does that impact your price and inventory? Game theory, what's the chance, success, for failure with each of the scenarios you've laid out? Or you can even use decision trees to look at your percent chance of success and failure with each scenario. Next, financial ratios. Banks look at this a lot, but we should all be looking at your ability to pay back debt. What's the margin and profit? How are you analyzing it? How does your margin and profit compare to your competitors or other geographic regions? And this all goes down into how well you have a chance to remain in business for future years. Because the competition is always developing new products, getting faster, getting smarter, and getting their price per unit down. You need to be looking at year-over-year trends and industry benchmarks. I've got one client that's got a construction company, and he has so many metrics, benchmarks, it's unbelievable, where he's comparing number of superintendents to overhead, number of superintendents to revenue, overhead to revenue, overhead to supers. It's he looks at this information monthly, and he knows ahead of time when his company is headed for a negative trend. Loan and banking risk. How well is your bank secured? In 2008, a lot of banks that went upside down, and because of that, they called in loans that weren't necessarily bad loans, but they needed the funds. And that's things that you or your CFO should be looking at, having quarterly meetings with your banker. Also, your investment risk. How are your investments diversified? What's the quality of investment? Have you looked at risk versus return and interest rate versus term length? Next, I'm going to move into operational, which I'm going to say is more of a tactical type of risk. Do you have a plan for when things go wrong? Do you have internal and external controls to document the process and the ownership? And I could go down 27 different rabbit holes on this one, but when things go wrong, it could be a natural disaster. It could be the main owner dying suddenly in a car wreck. What happens if something happens to your plant manager, your general manager, your director of sales? Do you have all your clients locked in Salesforce? Do you know who the clients are? Do you know who the customers are, the key contacts, how much business you've done with that particular company? These are all controls that you need to be aware of. If you have a manufacturing operation, I'm a big fan of standardized procedures, job descriptions, what each person does. And another thing is, if there's one or two owners, make sure you've got a buy-sell agreement. That speaks for itself. Next, I want you to keep in mind this is very high level and generic and may not apply to every single business, but it's something to think about. And then as we go through this, if it doesn't apply to you, just put it aside. But if it does apply, then let's kind of measure it and say how likely is this to happen? And if it does happen, what's the dollar impact? And that's the way I like to analyze things, and you can start chopping away at the biggest risk, most likely risk first. Ethics. This doesn't necessarily apply to every business out there, but ethics is very important. Whether you're a small company, I've seen it with negative publicity for a small company, or a large company where confidential information goes out. Conflicts of interest. Does your purchasing manager, is he receiving inappropriate gifts? Where's his loyalty? Physical security and crime, environmental, employment, and then safety. Are there any unsafe work environments or any product safety failures if you have a product that's sold nationwide? What is the risk with that? I was recently pulled into an operation locally that has a weld shop, and they had an eye injury. There was no chemical cabinets. There was no eye wash stations. The MSDS sheets were outdated. There was no safety procedures, no safety glasses on the floor. It was all word of mouth. It was a new operation, so we now have it set up with procedures. We're reporting safety incidents. But something like that, if you have a major injury or death, trust me, you do not want OSHA there making an urgent call.
Hey, Norm, this is Kevin. So just from I guess to put this in perspective, from a safety perspective, what could be the impact? I mean, what are these guys facing from a financial obligation or anything like that?
For this particular scenario, OSHA was not called in, and the gentleman did not lose his eye. But if you're aware now, I think the OSHA reporting guidelines have changed that if you have a death on the premises, I think you have to call into OSHA within 12 or 24 hours. And then there's automatic fines for death in your facility. Typically, if you're showing that you were at fault or you didn't have proper safety procedures and caution set up within your organization. Is that kind of what you're looking for, Kevin?
Yeah, I mean, really, most companies have insurance to cover some of this stuff, but when you start having to pay fines, say for environmental hazards, or you've injured somebody on the job, or God forbid someone has died as a result of being employed under your organization, I think the implications not only are to the individual's families and the impact of not having someone around to be a mother or a father or any of that. So there's you've got the social aspect, but also the financial aspect of it as well can be very costly to an organization. I've seen it to the point where it can be devastating to even put a company out of business.
I have seen the same thing, and you brought up actually a great point about insurance, because the insurance rate for this company to cover workers' comp is quite high, and it keeps going up every year. So we've kind of worked with them to set up a safety program where we have a corrective action team. We meet whenever there's a safety, what I call a close call, a first aid, or a recordable. A close call could be someone almost getting hit by a forklift or almost getting cut with an instrument, all the way to a recordable, which is where they need medical care and they lose time from work. And we're tracking those over time. We're tracking the instance by which body part, what piece of equipment, and analyze all the information, try to make sure we eliminate the possibility for any future first aid or recordable incidents. but their insurance is shot up because there's probably once a month somebody going to a local MD 360 or doc in a box type place for a couple of stitches or something in my eye, and they see all that. So whenever they pay out, even if it's a few $100s, they know it's a high risk in that scenario.
Okay, thank you, Norm.
All right, Kevin. Next, I'm going to move into indirect risk. And the reason I call it indirect, that it's more of long-term implications if you don't take care of these issues. And I start out with strategic risk. Failure to have a strategy or incomplete plan for long-term, or even reputational risk, which affects the trustworthiness of a company. You can have negative consequences if you or somebody in your organization is found guilty of a crime. And then social media has been a huge impact for this. But strategically, does your company have a long-term plan of where you want to be in 5 years all the way to 20 years? And if you guys have done any of these business books, you would see the Japanese would actually do business plans for 100 years out. They know specifically what industry they want to be in, what they want their revenues to be, how they're going to grow year over year over year. And a lot of the organizations I work with don't really have 5-year plans, much less really long-term plans of where they want to be in the market. How are they going to expand geographically? How are they going to expand to new products? How do they manage that with the overhead cost? And how do you grow and stay cash flow positive while you're doing that? If you've got a long-term plan, you typically have a way around those risks and are managing those risks and managing your cost as you grow. Personality risk. I think Kevin mentioned this in the beginning as well. An entrepreneur tends to be overly optimistic. If you're an entrepreneur, you started a business, you're the president, and you have a CFO, your CFOs are typically risk averse. And they're going to make 2 different decisions, especially a risk-averse CFO versus an aggressive CFO. There's going to be clashing of where the direction of the company is going to be. You need to be aware of those risks and address it accordingly. Legal risk. I've only named a couple here. Intellectual property and patent infringement. One of my past jobs is we were probably the largest patent holder in South Carolina, and we would either patent or protect almost every process, piece of equipment made, a new design, and this may not pertain to you, but you do need to be aware of if you do tweaks on any machinery, you make your machinery run different, there could be protection that you need to apply for and evaluate it. And it actually could be another revenue source. And like I said, that's just a couple of the legal risks. There are obviously a lot more lawyers than I have time to even talk about. Compliance risk. Obviously, some industries are more controlled by compliance than others. Fair trading laws, price fixing, and collusion. We typically don't hear a whole lot about this, but collusion and price fixing really ties into, do you ever talk to a competitor and talk about prices? If so, it's starting to get into risky area. If someone finds out that you and a competitor are sharing prices of how much you charge somebody something, or you charge competitors or charge customers different prices, and you talk about how much you're going to charge a customer, that typically goes into price fixing and collusion, which has 6 or 7 digit type penalties associated with that. And as Kevin said, that puts a lot of people out of business quickly. Next is reporting risk. I'm going to spend a little bit of time on this one. It has a lot of depth depending on the size of your organization. This is your risk tolerance as well as your CFO's risk tolerance. Reporting risk, let's look at it from the people perspective. If you have a larger organization and you may have a whole department that gathers data, inputs it, whether it's your accounting department or whether it's a manufacturing operation, what are you doing with the data? How accurate is the data you're collecting? From an HR perspective, how accurate is your head count? How about training, motivation, teamwork, and the effectiveness? If you have an accounting department that's pulling data from a data source and they're manipulating the data and there's a place that you could input it wrong, that could have a huge impact for your organization where your financials come out wrong or you make a bad decision. Reporting from a process perspective. What's the process for attaining your financial data? Is it automated or is it manual? And even automation has its risk associated with it. I've had companies that have automated data pooling, but it doesn't pull the most recent information. It pulled the previous month's information because someone had not updated it. All the data was wrong. How well are you communicating this? I'm going to say vertically and horizontally. Vertically, if you have a problem, does it get reported up or reported down? From a horizontal, has someone already pulled that data, or does the data get pulled twice? How well are they communicating? That's more of a process reporting. What about systems? We have systems that convert. In fact, Kevin and I were talking earlier about an automated system to pull from QuickBooks into Excel. Well, how dependable is that system? It's communicating with software, hardware. There's typically conversion factors, and then the automation side of it. Do you have a double check step in the process to make sure it's accurate? And lastly, on this slide is timing. If you have reporting standards, timing can have a huge problem. Are you aware of that? Have you thought through? What's your backup plan? Next, moving a little bit higher level, and hopefully this won't apply to anyone, but let's talk about transactional risk. Companies and industries that do all cash transactions, they have handling risk. Think about the casinos. Think about vending machines. If you have all cash transactions, what are the risks associated with handling that cash? What can happen? What can go wrong? Have you thought through all the scenarios? And the opposite, what about online transactions or electronic transactions? How secure are they? And I had a buddy of mine that has a software company, and I'm going to go into this now, but he talked about the scenario where no matter how much software and protection you have on your company and your transactions and your systems, you could have the best software out there. But you have one person that goes to the wrong website or drops their flash drive. They took data and they dropped that in the parking lot. You can't control those things. So you need to talk about individual process and procedures of how do the individuals also protect the system. Country risk, and this kind of ties in with terrorism, political risk, and I'm going to say natural hazard risk. There's all kinds of scenarios that can happen if you're in a foreign country having an operation in Japan versus Afghanistan. It's going to be a different risk tolerance. What's the likelihood of terrorism? What happens if the state or a political faction takes over? Have you thought through that? What's the scenario and what's the plans? Natural hazard risk, we talked a little bit about that earlier. Depending on geographic location, some of these are going to be more risky than others. And lastly, I put in here on this slide is inaction. What's the risk of not doing anything? What happens if you have board of directors or other oversight that are not actively involved in driving the management team? That inaction has a risk associated with it as well. And sometimes has personal consequences. Next is the risk of the unknown. we've talked about some of the known risks that I've identified, what I would call known risk. Then we have known unknowns. We're aware of the type of risk, but we don't know the complications, whether it's solar flares, impact on the communication within my company. But what are the unknown unknowns? That's sometimes referred to as a black swan. This was coined, it's best put by the definition, as a concept of an event that is a surprise and has a major impact after the fact. The event is rationalized by hindsight. I've done a couple of examples here together. 9/11, World War I, the internet, and the personal computer. All those had a major impact and was a surprise. So that's kind of a different concept that I picked up in one of my readings. So a black swan is just really kind of thinking out there of almost like worst case scenario, what's going to happen to my company or me as a person and how it could affect my financials and every part of me. So that's the way I want to wrap up the presentation, basically is with the black swan, because that's always very intriguing. I get a lot of questions on that one. But in the end, as I close this out, I put the key is good communication. And the reason I said good communication is the fact that you have to communicate, if you're the business owner, to your CFO, to your accountant, to your operations person, to your sales guys, to your tax person, to know what your risks are and make sure there's a good flow of communication so your accountant knows what's going on with your business and your business is making information available to your accountant so you can make good decisions and good analysis of your risk. Kevin, I want to thank you for your time. Robin, thanks for coordinating this from the technical standpoint. I'm going to turn it back over to you.
Okay, thank you. At this point, I'd just like to say we really just scratched the surface here of what's available or what's in mind from a risk standpoint for your company and also for your personal lives as well. But there's a lot more behind the scenes and a lot more below the surface than what was exposed here. All we wanted to do at this point was to just maybe expose you to the different kinds of risks that you might want to be considering. And we can go into a lot deeper discussion about these individual risks that Norm has brought up, and probably we'll look at hosting some webinars along those lines later this year. But right now, we just wanted to get you thinking. It was thought-provoking to get you thinking about those different kinds of risks. So at this point, we'll entertain some questions, and then I'd like to remind you that the webinar is being recorded, and we'll send it out in the form of a web link via email in 2 days. And so, Robin, can you please ask the questions that have been identified so far?
Sure. I believe this is from the earlier part of the webinar. This comes from Alan. What are some good ways to prevent fraud or inaccurate record keeping?
Okay. One of the best scenarios is having two people overlook each other. In other words, you don't have one person doing all the part of the payables and writing the checks. They may process the payables, and then the other person writes the checks and verifies the information. Same thing on receivables. Someone's inputting all the receivable information, and someone else is collecting the funds. So it's really duplicity and oversight. But I can't say enough. You need to have two set of eyes on everything like that.
I've even seen that go so far as like duplicate signatures on a check as well. I mean, in some of my former companies, we have check writing requiring two signatures before money is going out the door.
Yes, it's huge. I've seen it more in the small business because there's not as much oversight. There's a lot of personal trust with an individual. They've worked for them for years. But I've also seen in the larger organizations, as you said, Kevin, one place would even once a year do a paycheck audit to ensure there was no false employees on the payroll. The accountant from a different location would come hand out checks and personally verify there was not a kind of a fake person on the payroll.
Another one I've seen too is a vendor audit. To make sure there's no false vendors set up in the organization.
Holy smokes. Yes, I was personally near this one recently that the guy's in jail now, has been for about 6 months. It's very, no matter what you do, the thieves always get smarter and smarter, so it's always adapting to the changes. But what had happened, he had worked for a company that I'm going to say ABC for 15 years. He went out on his own, had his own company, and started sending fake invoices back to ABC from one of his known vendors. And he just set up the same name as the vendor. So say he was John Smith Enterprises was selling to ABC. So he set up an John Smith Enterprises in another state with a fake P.O. box and started sending in invoices. Well, the invoices weren't verified to receive for services or products, and he basically stole over $1 million from this company.
One of the things too that is really becoming a major issue is cybersecurity. So you can worry about internal fraud, but you also have to worry about people tapping into your organization externally, whether it's your bank accounts or your credit cards or anything like that. And cybersecurity is becoming the #1 issue among businesses as far as losing value, losing funds, losing intellectual property, and so forth. And one of the recommendations that I would make, if you haven't thought of this as an avenue for your company, there's a book called Small Business Cybersecurity that you can buy on Amazon. And if you haven't started thinking about cybersecurity for your company from a fraud aspect, this would be a good source for you to start to look at and evaluate, how's your company protecting itself from that standpoint. So anyway, just thought I'd throw that out there too.
Okay, great. Y'all covered that one very well. I've got another question here from Bridget, and she asked, how do you balance risk with cost, resources, time, and time constraints?
I hope I don't offend anyone here, but a Southern term I've always heard is, it's kind of like the old adage, how much insurance do I need? Well, if you don't have a pot to piss in, you don't need insurance. But it's defining, in this scenario, as I kind of put at the beginning of the webinar, you need to write a list of all the ones that may be a risk for your company. And then what's the likelihood or % chance of this happening to you or your company? And then do another number out beside that and say, what is the dollar impact? And that way you can see the likelihood of something happening. What's the financial impact? Because I'm a dollars and cents person, I analyze everything by numbers and dollars. So then you have a scenario, and you almost have a force-ranked list of what you should be working on first and foremost. And sometimes if the solution is more expensive than the problem, then it's not worth the solution. But at least you've given it a fair shot, you've analyzed it, and you've taken a calculated risk, which is okay. That happens day in, day out. People take calculated risks, and sometimes things go wrong, but at least you're aware of it. You've addressed it, you've analyzed it, and you decided not to buy that insurance, or you decided not to put together a procedure to prevent some type of risk failure.
Okay, thank you. And I have one more question, and this one is from Robert. Let's see, he says, you mentioned financial ratios. He said he'd been working on a dashboard, but he was not sure what he should include on that. Do you have any suggestions?
that's pretty, it's a broad term, and the short answer is it depends. Depending on the industry you're in, do you manufacture products? Do you have inventory? Whatever is really impacting your organization, and sometimes it takes a deep dive to go in and look at your organization. If we find out that inventory is a big impact to your cash flow or to your profit levels, you probably need to start analyzing your inventory. How often does it turn over? What's the age of the inventory? What's the average age of the inventory? And really look at your inventory from a multitude of perspectives. You can start looking at it, how will, when you price something a certain way, how fast does inventory move? And that turns into the price sensitivity issue. But if you don't have inventory, it could be, really looking at your receivables and payables. What are the terms on it? Is there any way to maximize it for your potential? You can look at days payable, days receivable, and really the way you have to track that is look at it over time. Looking at it from one day here and there does not really provide a good perspective, but really a trend analysis over a long term to see if you have a trending up or trending down. And anyone that's been out there realizes if they've done business with a 500-pound gorilla like a Fortune 500 company, they tend to start pushing the small guy on, I'm not going to pay you in 30 days, it's going to be net 60 or net 90. But yet they'll do that and squeeze their suppliers on the same end and pay them further out as well. So it's really kind of taking advantage of the cash flow turns and using it to their advantage. But really the best thing to say for your business, whether you're retail, industrial, commercial, small, large, is really what are the, kind of look at your scenario, what are some of the factors that impact your organization, figure out the best scenarios and track them over time. And I've had some clients I've worked with and putting together a dashboard where you plug the number in Excel and it kind of gives you a red light, green light, a speedometer, go, don't go. And so it kind of gives you a good way to look at it from a daily perspective and also a long-term perspective. So hopefully that was enough advice, because it was vague enough you could drive a truck through.
All right. Thanks, Norm. And at this point, I will turn it back over to you, Kevin.
Okay, thank you. And one of the things I want to invite you guys to do is that if you do have questions, and again, this was a very generic overview of some of the risks, but if you want to dive a little deeper into some of these, I would invite you to send us an email, and you can reach us via a web address that I'll show you here, and an email address that I'll pull up here in just a moment. But and we'll put you in touch with Norm. Norm can give you a whole lot more advice than we can about this, but and he can also work with your companies to help you to set up something that works for you. But before we dive into that, I'd like to just remind you that the webinar is being hosted by Chief Executive Boards, and I want to invite you to visit our website for additional insights and upcoming events and webcasts that we have listed on this slide here today. And so you can see we've got a couple other webinars that are going to be happening in the coming months and throughout the year. Just wanted to show you the next two that are coming up and invite you to join us for those. I'd like to also invite and thank our presenter, Norm Poole. We'll probably be having him as a guest again here to maybe deep dive into some of these subjects, but I hope you found it to be helpful today, and I want to invite you to contact us at this email address or the telephone number that you see on your screen. You can contact Robin Taylor, and she'll put you in touch with the right person if you contact this number. And so I want to invite you to join us for future webinars as well. And so we invite you, we look forward to speaking with you regarding future engagements with Chief Executive Boards and Money Pool if you want to talk with Norm. And we want to wish all of you a great week ahead. I want to thank you and say farewell, and this concludes our webinar.